Today we are going to learn how to make short-term investments, BTST decisions or buy today, sell tomorrow decisions using the Fibonacci principle. Here many rules are there, but which are the important rules that we are going to learn, and based on that we will just design our trading habit. So whenever we talk about the short-term investment, the duration of your investment is varying from 1 week to 1 month. And BTST decision or sell today, buy tomorrow, STBT decision means today you initiate the trade and the next day you exit the trade. So here, whenever you are making a short-term investment decision or BTST decision, the decision is more critical. Decision is more exposed to the external risk. So we have to be very careful in choosing that things. However, the Fibonacci helps us a lot for deriving this thing. So whenever you are deriving the BTST or STBT decision, buy today, sell tomorrow decision, you need to look into these two rules very carefully. Stock which moves above the death zone on intraday basis and close above the death zone and below 1.236 retracement, that is very important. Second, stock which reverse from the death zone of the sell side and close in the band of the buy and sell entry level, that is also very important. So these two aspects of the things, if you are encountering in particular stock, then you have to enter a BTST. So if I just go to some examples here, how we can look into the example. Suppose now Nifty today it has closed at, you can say, at 81, we have closed at 8195 level, and also we made a low. So just I'll go to the NSE to get these levels where we have closed and what was the level for it has done today. So today's high was 8248, close at 8195, low was 8152.55. So 8152.55, 8195, and in fact we have also made a high of 8249, 8249, 8249. So this is the high, this is the low, and this is the price you have closed. Then imagine, so what is the volatility of the Nifty as per the NSE data, not as per our calculation. So daily is 1.2, annualized is 23. So daily is 1.2% of volatility is there, 1.2% of volatility. So here, if I'll just go for calculating the same factor with my or static calculation, static Fibonacci calculation, if I can do, so 42.45, and we have the low was 8152.55, 8152.55. I am taking the static method, not the dynamic method. So again I will be taking the high of 8248. So this is the data, this is the things you are getting. So now just let us copy this same info and get all those other info here. So these are the levels we have got, 8162. So whatever the value we have derived from the high, it is coming in this level, and currently we have closed at 8195. So we have opened also at 8207. So we opened at 8207, that is also very important, 8207. So if I take this low, high and this opening price into confidence, then I can say that yes, I was expecting based on the low As per the static method, I was expecting 8221. It has achieved, gone beyond that 8248 I have achieved. Then I have slipped and I have just closed in that 8195, which is above my death zone. So my death zone from the low is coming to death zone from the low is coming to 8185. I have closed above that. And similarly, the death zone for the sell side is 8221 to 8214. So this is the death zone for your selling side or from the high you have derived. And this is the death zone for your buying side, which you have derived from the low. As per the static principle of the Fibonacci, this is the thing you have derived. Now go back to this rule, what this rule says. Above the death zone in intraday basis and close above the death zone and below 1.236 retracement. So based on this particular data and based on this closing, so what decision I should take? This is the high has occurred. This is the low has occurred. From the low, if I am doing the calculations and I am getting these levels, and in this particular level, it is I am getting that my death zone was 8179 to 8185. I closed at 8195. So what decision you will give? As per this particular rule, my 1.236 retracement is 8205. As per this particular rule, what decision you are going to give me? Whether I will take it as a BTST decision or not. Static way, I have told you, you are above this particular death zone, so you can think of buying it. So dynamic presentation also we are going to do. We have found out the daily volatility from the NSE site as 1.2, last traded price 8195. Based on that, this calculations has come. Reference price will be 8195. From there, we have derived all the Fibonacci retracements. Then we have to see currently where our price is. So if I can say that 8195 is the ending price. Today it has opened at 8207. It has opened at 8207. So instead of this is the closing price for the day. So if I can start my reading from 8207, that will be more appropriate to take the BTST for tomorrow. So I'll be taking the reference from 8207. So that will be more appropriate for tomorrow, because this price happened after lot after that uptrend and downtrend movement. But what is the reference price for the day? 8207. If I am taking, based on that, if I can compare, currently I am at 8195. I have gone till 8252. So 8252, so near to this death zone I have just approached. 8146 was my death zone. So I have just closed near to that. I have gone, I have just reversed, and I have also closed in the band of this buy entry and my sell entry. So this is the band in which I have closed now. So this particular study says I have a reversal from a down from the death zone. So as per the second rule of my Fibonacci BTST relationship, stock which reverse from the death zone of the sell side and close in the buy and sell entry. So this is the one condition. Second condition, stock which move above the death zone on intraday basis and close above the death zone and below 1.236 retracement. So this is for buy today, sell tomorrow. If you are going for sell today, buy tomorrow, same thing you have to do in a opposite order or vice versa way you can utilize. So stock will be fall below the death zone of the sell side and it should be above the 1.236 retracement of the sell side. This condition should satisfy, or stock will be in a rising trend and it will go to the death zone of the rising trend, and from there it should reverse and close in the buy and sell entry level. That time also you can think of selling it. So either of this condition if you are analyzing, then you can enter a BTST or STPT trade. Now moving to the next part, short-term investments. Whenever we are doing a short-term investment, so what is our objective of this short-term investment? Whenever we are investing in a short-term, many people used to say that I am a short-term investor. I am a short-term investor. I am not a long-term investor. But the very definition of a short-term investor is that the investor will be parking his money for a small duration of time, or parking his unused money in a small duration of the time. At same time, the investor will not take any additional risk or not aim for a long-term movement of a price value or your price to book value or your any multiple of your EPS and all. Investor's objective is very small. So whenever you are entering to a short-term investment decision, you have three zones or the three different objectives of your short-term investment. One, your entry zone, initial entry zone, where you should buy. So here only the buying you have to do. Short-term investor means a short-term sellers, you cannot say. Short-term investor means he is an investor who puts his money into the market. He buys the instrument. Whenever we talk about a for short-term objective, he is selling and other things, he will be classified as a trader. He will not be an investor at all. So here the investor have an objective to means initial entry zone where he should enter a trade. Second part, if the his entry into any particular counter goes against him, then he has to accumulate. There should be accumulation zone. Post accumulation, it is not guaranteeing that it should go for a profit. It may again give him some bad experience on his investment. So if the need rises or need arise, then he has to go for a hedging. If there is no need for hedging, then he will be just holding his portfolio, and there is a distribution zone, means he has to book the profit and come out from this. So these two also having a specific rule. So whatever the rules we are learning here, these are the rules of an institution. These are the rules followed by many of your nominant mutual fund industries analysts. So initial entry zone, whenever we found out any value stock, when a value stock means the stock is having a great beta relationship with the, so you have means those who are the investor, they will be knowing that there are two types of your investment objective. One is your value investing, another is growth investing. Whenever you talk about a growth stock, it will be having a means P's will be, price earning will be good, its B that book value will be good, all these things. So it is growth stocks. And similar way also you go for a means value investing. Whenever you are finding out everything is good with the company but there is a correction, there is a specific correction happened and that has brought down the price, then you have to go for a value investing. So value investors and growth investors having different objective. Growth investors always aim from a long term objective, value investors always aim from a short term objective. And value investors looks at the technical parameters and beta factors. However, the growth investors look into the low beta factors and they also used to look into for a greater profit additions part, means how the company is being profitable in the long run. So we are talking here about the value investors, those who are looking at a value in a company. Company is good, no external news is influencing, nothing is happening, but prices has correct. And it is a high beta stock. The value investment should be done in a high beta stock because the reward also should be promising and it should give you an opportunity to hedge also. So all these things also will be very important here. So from a monthly high, because here your objective is for a month. So from a monthly high, if the price falls to 1.236 or 1.618 price zone as per the Fibonacci, or you can take static method or dynamic method, whatever may be. From a monthly high, once the price corrects to 1.236 to 1.618 price zone, then you should make an entry. Your asset distribution must be 30%. Means if you have 100 rupees in your pocket to invest, you will be investing only 30 rupees. That should be your objective. Initial entry zone. This is the initial entry zone wherein you have to deploy your money for a short-term investment objective. And you are a value investor, you are not a growth investor. So once that part, your investment is done, 30%, and it is a great correction, 1.236 to 1.618 retracement. Whenever it happens, the bounce back will not be very sharp. In very quite few exceptional cases, you can have a sharp bounce back or else not. And more probably you will be falling further, and you may end at a accumulation zone. So what is the accumulation zone? From the point of entry, if the price falls to by 1.236 retracement zone, if it is further fall by from your point of entry, what is the volatility there that time? If you have to take a note of that volatility and take 1.236 retracement and just subtract from your entry price, you will get that where my accumulation zone. And in the accumulation zone, once you enter, then you have to prepare for a hedging zone. If the price further falls and it goes to 1.618, means 2 cycles of fall it is completing, then there is a need for a hedging. So you need to hedge, and hedging should be done in a 50%. If you have that time 60 rupees of your money is employed, so you have to hedge 30 rupees of your money. So this hedging is done to protect the new investment what you have made. This hedging is done that if there is a small, again there is a cycle of one third cycle continues in the falling trend, then you may be entering the get some value, and again you can go for an accumulation. So this hedging have a objective to protect your accumulation zone investment. This hedging having the objective to give you another chance for a accumulation. For that reason only you are hedging these things, and then you go for a growth rate or distribution zone wherein book profit if the fifth cycle of the price derives from the low of the accumulation zone. If you are deriving that things, then you can think of a distribution. So I'll just give you one very small example here. So now if you are just going for any one stock, or we are going for one equity, say we are going for ICICI Bank. So ICICI Bank. So this is and these are the very, you don't require any sophisticated software for this also. So I'm just going for this month I want to do. So let me go for the last month. So I'm not looking into the golden ratios for doing this thing. I'm just looking in my Fibonacci principles. So this is month of the October. I am going to do September. September, you had a high September month, if I can say. So if I can say here in the month of September, now you are in the month of October. So from here your month of September starts. So I can say till from 1st September I'll be taking till this one, and from just I'll put it in an Excel sheet so that it will be more appropriate. So 1st September to 30th September we have done. So minimum is already available with us. So maximum what we have gone, this is the high part of these things, high and low. So open, high, low and LTP. So first price is open, this is the high. So if I'll just go for a max function in Excel, so I'll get the maximum of all this number. So what is the high we have achieved in this particular 1 month? So this is the high 285 and 247 if we are getting here the low. So from high we have corrected. So September month, if you see, this 85 has happened sometime in the 18th September. From there you have slided and it has come down to the 47 range. So here, so this is the from this high I have to derive my 1.236 or 1.618 retracement. So 1.236 as per my Fibonacci rule, 1.236 or 1.618 retracement I have to derive. And that too, if I am telling that yes, by this point it is maintaining one annual volatility of 20, so or 25, so annual volatility. So that time what is the volatility, that is also important. So when it was 8 to 8 285, what was the volatility? Say 25 was my volatility. So what is the volatility coming as per for 1 month? So here this divided by square root of 365. So this will give me the daily volatility, and this daily volatility, if I can multiply it with square root of 30, so I will get the monthly volatility. Monthly volatility is 7%. So 7% is the monthly volatility I have achieved, and after achieving this 7% of the monthly volatility, so we need to take the price range. So price range we have to derive. So what is the price range? This one multiplied with this one and divide by 100. So 7 we have multiplied, so it is 7.16. So 20 rupees is the price acceleration, price is expectation into 1.236 retracement we have to derive. So 25 points it is coming. So 1.618 also let us derive. So 20 rupees is the expectation, 1.618 also coming, so 33 rupees. So if I want to invest, my first investment will happen at 285 minus 25, 60 rupees, 260 level, or it can again happen to 62 to, or it can happen in the 285 was the high. From the high we have made 252 to 260 is my first initial investment I will be making. Post making this initial investment, I have two more jobs to do. I have to find out a accumulation zone, and then I have to find out a hedging zone. So what is this? Is the place I have entered 260. I have entered to 252 to 260 is my enter. So any price range between you have to make an entry. Assume you have made an entry at 260. So 260 again 1.236 retracement comes to 234. If the price falls to 234.79 or 235, you will go for an accumulation. So this is your initial entry. So this is also you are going for a value investing, not a growth investing. So here accumulation as for the Fibonacci principle. If this accumulation fails and your price also goes to the price point of 227 rupees range, then this is a hedging zone. So you are not going to enter further stocks in this, rather you have to hedge it 50%. So whatever is your value you have invested, 50% you have to hedge with respect to some options or something. That hedging not necessarily to be bought one put option, You may think of selling a call option also at 260 plus level, whatever the value is coming. You may think of any kind of complex hedging also. You may have a separate option hedging strategy to protect this thing also. So anything you can form. So that is not necessarily that you should buy a put option. You can form any kind of option strategy, independent option strategy, independent from this particular investment to protect this thing. Once this hedging zone is achieved, or once this accumulation zone is achieved, now you're the fifth cycle. Till fifth cycle you can wait for your price to escalate. So each cycle, so different, once you enter, so this is 226 or 234, whatever in accumulation zone, what is the low it has made. So either 235 it has made, or it has fallen below and it is above 226. From there it has started bouncing. Anything happens in that scenario, you will start from there. You have to calculate 5 cycles. 5 cycles means each cycle will be ending at 100 points of retracement. If assume the same volatility is there and assume you have made a low of 227, if I can just tell this the same thing. So your first cycle, which will be ending at 247, then your second cycle will be ending at the same 20 rupees, it will be at 267, and the third cycle, which will be ending at the 87 88 level, to 88. Fourth cycle will be ending at suppose at 308, and the fifth cycle will be ending at 100% retracement level we have to follow. So fifth cycle will be 329. So here only we can get the distribution. So distribution means partly we have to close our positions and get that price back. So nothing wrong if you can go for a distribution at the third cycle also, at 288 level also, then partly, and means another part you can go in the fifth cycle also. This accumulation and distribution pattern for a value investing is highly rewarding. It is highly rewarding if you can do value investing as per this particular concept. It is highly rewarding. Is ending today. Most of the videos we have uploaded in our YouTube channel. You can get those videos. And the third week session will be starting from the next Monday, third week and fourth week. So third week you have a complete study on WD GANs concept and some of the option techniques you will be learning. Fourth week you will be learning on some of the advanced option techniques. So if you have not registered, you please register. Our site is down today, but most likely by night it will be up, so you can go for that. So coming to the products, we have totally 10 to 11 different products. So here we have courses comes as a printed book, 3 DVDs. All these concepts are well explained in the DVDs with audio visual lectures. And softwares are real-time softwares, and in all the dynamic things whatever you have learned, same dynamic concepts are implemented in this software. So if you wish to take all the packages, it comes at a price of 17,500 as of now. So, and different softwares has different prices, and separately if you are buying these materials, it costs separately if you buy it is costing more than 47,000, but those who are taking as a package, they used to get a hefty discount. So regarding the sales related any query, you can call to our sales number 984034891 or 04464995823. Or the script which satisfies this particular rule, but we have fixed for BTST, that script is more appropriate for our BTST trade. So here we do not have any particular affection towards any script for BTST. Rather, we need to check. We have to take a group of stocks. We have to check it which is the stock which moves above the death zone on intraday basis and close above the death zone and below 1.236 retracement. A stock which reverses from the death zone of the sell side or the buy side and close in the band of the buy and sell level. So if any such kind of opportunity we are getting, then we will be entering the trade. So will not be affectionated towards any particular. So there is, with reference to 8207, using the Fibonacci principle, using your volatility, you have projected this level. Now it says if the price rises and goes to this particular zone 8284 and reverses back in the how it has started, it has opened up 8207, gone to your 8245. How the actions has happened, just look into that. Why it should consider as a BTST decision, why it should not be told as a STBT decision for Nifty, what we have discussed now. It has opened up here and most probably you have observed the day's movement. It has gone to a high 8248. So it is definitely not entered to your death zone. From there it has returned and it has come to a level of your 8152. So 8152 happened after hitting this 8248. This action happened. So post this hitting 8252, you have returned and you are close now 8195. So you have not entered to the death zone. Neither cases, nor in the uptrend case, neither in the uptrend case nor in the downtrend case, you have entered to the death zone. Reference drawn from 8207. So this closing confirms that we should enter a BTST decision. Buy today, sell tomorrow decision. Hard things should be different. If these things could have been different, if I would have made a low, then from there if I have reversed to a high and then I could have closed at this thing, then my decision could have been different. So this is